Well, I think it's fair to say that this has been quite a ride in the stock market over the past week. We have seen the biggest two-day wipeout ever, with more than $10 trillion erased from some of the biggest companies in the world. Since the market highs back in February, that now feels like a lifetime away, the S&P 500 at least is down more than 17% as I make this video, which puts it very close to being in a bear market. I'm almost afraid to make a video like this, as anything can happen between the time I write it and finally get it edited and put it here on YouTube. In fact, I'm glad I didn't make this video just last week, as it would have only told you part of the story. Anyway, let me tell you what's going on, why this is all happening, and then let's talk about what we can do with our own investments. Okay, so there's now one word that is burned into the minds of every person who's been keeping an eye on what's been going on over in the States. And that word is tariffs.
A spoonful of tariffs makes the stock market go down.
The US administration has decided that they are going to implement a tariff on any country who they buy more goods from than they sell to them in return. Just quickly let me explain what a tariff is so that we get all on the same page. A tariff is a tax on a certain subset of goods that are imported or exported. In the example of where there is a tariff on an import, something we buy from another country, this charge has to be paid by the importer, that is the person buying the goods. It's not paid by the country selling you the goods or the company shipping them to you. It will have to be passed on to the consumer at some point. Now, they can be used to protect certain industries and even used to encourage investment in very specific areas of the economy. For example, the UK currently has a 10% tariff on all cars that get imported into the UK. This can protect the UK car industry by encouraging manufacturers to assemble and sell their cars inside the UK, as it will be 10% cheaper. If trade had no tariffs at all, then there would be the risk that cars made in places like China end up taking over the whole UK market and removing the whole car industry over time, because really they just can't compete. At this point, the UK would then be forced to import all cars, and this could cause a lot of risks in the future. Tariff used in this targeted way can make sense, but that is not what is happening here. Now, you might have seen the headlines and the videos of the president holding up a board of some of the highest tariffs that they implement, all organised by country. Trump is making it seem like the US is putting in a reciprocal tariff of just half the amount that they're currently charged by each country. You can see here for the numbers in detail, and for example, let's take one of the US's largest trading partners, China. According to the current administration, China is charging the US a tariff of 67%. So in return, they'll be charging China 34%, which is close to half of that number. Now, this is just total nonsense, and these numbers do not at all reflect the tariffs charged on the US by each of these countries. Firstly, there is no single magic number or percentage. Different goods and services can have different tariffs, and there are other trade agreements which can also override these tariffs. Secondly, China does not tariff the US anywhere near 67% on anything like that at all. This number has been made up based on the trade deficit, which is just the difference between what the US buys from China compared to what China buys from the US. The trade deficit has nothing to do with tariffs, and I don't need to have any kind of qualifications to tell you that. If you do just a couple of minutes of research, you'll find out that, and all the experts will tell you the same thing. Rich countries, like the US, will buy more things from poorer countries than poorer countries will buy in return. That is global trade, and if anything, this allows rich countries to have the low-cost consumer goods that they all want, like phones, electronics, clothing, you name it. These jobs in much poorer countries who make all of these goods are not high-paying quality jobs. They are manual, stressful, and often done in very poor conditions. Now, for some reason, Trump thinks that the US is being ripped off by countries which have a trade imbalance. I'm not sure where he gets his idea from, as the US benefits massively from the way global trade is already set up. The US is the richest country in the world, and they can buy cheap goods from all over the world without having to do the hard, low-paid, and sometimes dirty jobs that go along with it. If these tariffs stay in place, which is possible, as Trump has already said he intends to follow through with them, this will put the cost up on goods that US consumers buy. For example, an iPhone could cost more than 43%, and one firm's estimated that the cost could be as much as $2,300 for one of Apple's best-selling devices, should all of the tariffs be passed on to the customer. For reference, Apple makes about 46% in gross profit across their products in total. So this tariff would wipe out all their profits unless they raise their prices. Now, there's no easy way to move an entire supply chain and manufacturing capability into the US in a very short time. And these tariffs make absolutely no concessions for companies to make any kind of arrangements. There are lots of things and lots of products that the US could never make themselves, as they do not have the raw resources in order to do this. Likewise, there's a huge amounts of services and goods that the US sells all over the world that is not easy to create overnight. Think of it like this if you want to. Trump is saying that because there is a trade imbalance, this must be a bad thing, and he thinks all countries should be buying as much from the US as they sell. It makes no sense at all. And it's like me and you going to do our weekly food shop and being annoyed that we have a trade deficit with our supermarket. We spend all our money there to get our food, but in return, the supermarket isn't buying anything from us. Apparently, this must be a very bad thing, and the only way to sort it would be to charge the supermarket a tariff on everything it sells to us. Now, all that would do is put prices up for you and me and not address any of the real issues at all. Higher prices pushes inflation up, leading to lower sales of products, a reduced disposable income from consumers, and ultimately much slower growth. It's really very simple economics.
Stock market go down.
Now, with all of that put to one side, the market is pricing all of this chaos in, and going back to what I said at the beginning, trillions of dollars has been wiped from the values of companies on the stock market, and there's nowhere to hide. Generally speaking, a company's share price is based on all of the future cash flows that it can possibly produce. And at the moment, these future profits are set to be much lower as the costs of tariffs need to be factored in. However, the truth is that there really is no way to know what happens next, so we should all expect things to be extremely volatile moving forward as things change so quickly. Even as I make this video, I'm looking at a stock market with lots of green numbers currently, and things look to be making a bit of a recovery. Is this just a bull trap to get people to buy in before selling off again? I have no idea. And it's not something I honestly waste any of my day thinking about. However, this still leaves us with the big question: what are we meant to do about it as investors? How do we protect our investments? And what do we do if we've not even started yet? Now, my answers to these kind of questions stay the same no matter what happens, and some of you might get bored hearing it. Let's agree this first part. There's no way at all to know the future or to have any degree of certainty about what will happen next. Now, this remains true for anything in life, and it's especially true when you try and predict what will happen with the stock market. No investor worth listening to will ever make the claim that they know what will happen to the stock market next week or which stock is about to go to the moon. Those who do need to be ignored, but funny enough, they're also the people with very loud voices who tend to enjoy platforms like YouTube to spread their message and sell a product showing you what to buy. So if we're agreed that we can't know the future, where does that leave us when it comes to investing? As I'm sure, just like me, you want to be sure that you're doing the right thing. There's no point investing your hard-earned money now if in the years to come, you just end up losing money. Now, this part is always possible, so just bear in mind that for a moment. Investing is not any way to guarantee making money or guarantee any kind of return. Anyway, let's get a bit more optimistic for a second and consider this. Investing for the long term has a much greater success than trying to invest for the short term. That's the first lesson. If you want to see progress, all you need to do is zoom out for a moment and try to spot the current downturn on a really long-term chart of the stock market. You can take the S&P 500 if you like, or you can even take the returns of a global fund that has the most of the market inside of it. If you zoom out 5 years or maybe even a bit more at a minimum, you'll hardly see the most recent stock market dump. Also, I bet in the following 5 years or even the next year or two, this drop will just be a distant memory and none of us will even be talking about it again. The only thing that we'll be talking about is saying something like, damn, I wish I'd invested more money during this dip. I just never thought it would recover again. This is such an easy trap to fall into that as soon as stocks start to fall, we suddenly get the urge to sell and stop investing, which is actually the opposite of what a good strategy would keep us doing. All of us out there are amazing investors when the stock market's going up. We're full of confidence, we can't wait to get next month's pay into our stocks and shares ISA, and we'd wish we'd started sooner. But the moment things don't look good, our brains completely go into meltdown, the plan goes out the window, we're worried about what's next, and our long-term thinking suddenly turns to worrying about what's going to happen next week.
I love Tesla.
Now, all of this is perfectly normal and completely human. Our psychology is wired against us when it comes to long-term investing in the stock market. I still get the exact same feelings that you do when the market turns red. However, all I've learned to do is just acknowledge these feelings and teach myself to not act on any of them. It's really as simple as that, but it's also much easier said than done, and it only gets easier the longer you do this. Recently, I made a video saying that we need a stock market crash. Now, I had no idea what would happen next, and the point of the video wasn't actually a negative one. Without spoiling it, the video was about how a stock market crash is actually a great thing for new long-term investors because It's much better to have a crash at the start of your journey than towards the end. Also, I made the point that it's really good learning experience to go through stock market crashes and corrections, as these are actually virtually inevitable in any long-term investor's journey. The sooner you accept that this is just part of investing, the better you'll be when the next one comes along. As we know, there will always be something lurking around the corner trying to make us doubt our long-term plans or just sell out entirely. I can bet that unfortunately, there'll be a ton of people who may never start investing because of what's happened over the last week. And instead, these people will just stick to savings accounts for the rest of their lives. Long-term investing is not something that's guaranteed to make you money in the short term, but you do have a much better chance of being able to grow your wealth in the long term if you stick with the plan. On that note, what is the plan? Well, let me tell you what I've done and also what I might do if I were in some different shoes. My plan has not changed, and I've already made my first investment into my ISA this tax year, and I even managed to top up my pension just before the tax year finished from my limited company. I did not worry for a single second about the price of my investments. In fact, I welcomed the lower prices and I was really eager to get some new money in to start the year. For some reason, the stock market is the only place where people avoid when there's a sale on. You get to buy the same businesses for a lower price, yet this somehow seen as a really bad thing. People will buy on the way up when things look good, but they avoid them on the way down. It makes no sense, and I think it will always be this way. For me, this year I'll be doing things exactly the same as always. Investing into my ISA and pension as much as I can, and inside of those accounts I invest in low-cost, well-diversified funds and ETFs. It really is that simple, but always easier said than done in practice. Now, if I was just starting out and my first investment was going to be taking place right now, so long as I am a long-term investor and I'm investing with decades in mind, I'd also do the same thing. Changing your strategy because the market goes up or down makes no sense to me at all, because it's always just going to do that. And it's this reaction to the market that causes retail investors like you or me to consistently underperform the market in the long run. I should add that even the professionals do this too. They keep buying and selling, trading in and out of positions, reacting to everything that happens in the stock market, chasing trends, but in the end, the vast majority of them fail to beat the market, and I don't think this will ever end, to be honest. Now, what about if you're about to retire or close to retirement? Obviously, I'm not a financial advisor, but my thoughts would also be very similar. If you had set a date to retire, then you would have already had this plan for a long time, and you should have been putting aside money in cash or cash-like investments ready for this moment. The price of the stock market should not be dictating your retirement in the short term. You should have always known that there is risk with the market moving up and down at any point. And this is exactly why you keep some kind of cash in high interest savings or money market funds ready to pay bills in the short term. This could be enough cash for a couple of years, as usually this is enough to ride out any stock market downturns. Also, before people have a go at me in the comments section because they never watched this video until the end, retirement is not some single date where you have to sell everything. You need your investments for decades to come, and you are still a long-term investor when you start retirement. Yes, you might not be adding new cash to it, but the rest of the rules still apply. You keep long-term, you don't react to the market, you adjust your spending if you need to, and you make sure that all short-term needs are covered. I'd love if we lived in a world where the market only went up in a straight line, but it doesn't, so get used to it if you haven't already and be prepared to make changes. If you want to be an investor growing your wealth at the start of the journey or even at the end of the journey, the rules remain exactly the same. Anything can happen in the short term. Corrections, crashes and bear markets are part of this journey. There's no knowing if you'll experience the best decade ever or the worst one. This is not in our control, and therefore, for me at least, I don't spend a single second worrying about it. It sounds crazy, but that's exactly what I do, and I put my money where my mouth is every single time, sharing most of it all here for everyone to see on YouTube. Now that is weird. Let's be honest, but I'm trying to normalize it. Anyway, I'll be keeping a close eye on things as the days move on. If there's any big developments, I'll make sure to keep you updated, and you'll see me post my regular portfolio updates on my own investments shortly later this month. Now, if you want to get started investing or you need some ideas on the best stocks and shares ISA accounts, you can check out my video here on that one, or check this one out if you want to go back to the guide for beginners. I'll see you in the next video. Happy investing.
In the most delightful way.